Alright guys, welcome back to MMGinvest. So on the weekends I will try to bring you guys macro market updates, and I will cover some of the price action in equities and the entire markets globally and whatnot. If you're new to this, check out the links below this video and check us out in our free chat rooms. Alright, so today's breaking news was prior to the midterms, Trump is trying to get his base motivated.
We are looking at putting in a very major tax cut for middle-income people. And if we do that, it'll be sometime just prior, I would say, to November. And are studying very deeply right now, round the clock, a major tax cut for middle-income people. Not for business at all, for middle-income people. Kevin Brady's working on it. Paul Ryan is working. We're all working on it. And we're looking at a major tax cut for middle-income people who need it.
What was your time frame for that?
I would say sometime around the 1st of November, maybe a little before that.
This is huge because that is a point that the Democrats have really been focusing on, that there haven't been tax cuts for them.
All right, so Trump's actually pretty brilliant. We've all expected more tax cuts and less regulations to come, but everyone was expecting it after the midterms. But Trump wants to make sure that he's going to stay in power, and so he's announcing more tax cuts for the middle class, by the way, right prior to the midterms. So if anything, this is a call to action from Trump to the conservatives and anyone else in the middle who could lean left or right, right? And if you want these tax cuts, you're gonna vote conservative, all right? And I am speculating, and I'm assuming that Trump's gonna stay in power. The left will not take the House during the midterms on the first week of November. I think it's November 6th, somewhere around there. And that is good for the stock market and for the U.S. economy as a whole, because Trump, obviously the stock market loves Trump. It's gone up massively since his election, and you could argue that they've already priced in the previous tax cuts, the previous cuts and regulations. The market's already priced in the tariffs, the tariff war between Canada and Mexico, which actually turned into a new trade deal, and Trump won on that as well. One could argue that the trade deal is not that much greater than NAFTA, especially from a libertarian standpoint, but it is better than what we had, because Trump's major goal here is to bring back manufacturing and to lower the trade deficit for the U.S. globally. And for him to actually try to save the economy here, he is going to have to stay in power for the next 2 years, the second half of his first term. And I've looked on Google Analytics and whatnot. So far, so good. It looks like the right will stay in power, especially after all of the fiasco with the Supreme Court nominee and then and the Indian stuff, Pocahontas. So let's go into some other news. So Russia and China have been trying to de-dollarize, right? So for the past few decades, not few decades, but for many decades now, the U.S. has kept its world reserve currency powers through all of the Saudi Arabian oil, right? And the U.S. recently, with Trump administration, they have used the SWIFT system to attack Russia and China, because China, one, is obviously is in an economic warfare with the U.S. over trade. China wants to keep its trade policies the same, which is gutting the U.S. And Russia obviously is well, you could say Russia doesn't go along with the Middle Eastern geopolitics of things, and I do not want to get into that. So sanctions have been put on Russia in the past couple of years through the SWIFT system, which did devalue the Russian ruble or ruby. It's one of those. And China obviously is in a trade war with the U.S. right now. So it's in their best interest to weaken the United States as much as humanly possible and to not trade based on their currency system. And they're going to try to get the Middle East, Saudi Arabia, and the rest of the world onto a different international trading system, which is not linked to the SWIFT system. And the SWIFT system is the U.S. legacy system, which which helps keep the dollar as the world reserve currency, right? So this is actually big news. Of course, mainstream media doesn't talk about this, but this is, in the long term, this is very bad for the United States, right? So just another another macro fundamental here that is enormous, and MSM's not talking about it. Of course, China also created the new gold exchange, and that is also driving the same drift away from the SWIFT system. All right, so in Europe, Brexit is constantly being delayed, but the people are pushing Theresa May to finally go through with it. Now, Europe is on the brink, and I'm going to talk about Italy and Spain. They're currently pretty much going bankrupt. Also, with the populist uprising across Europe, it looks like Merkel, which is Germany's prime minister, and Germany is pretty much the European Union. Germany runs the show through Brussels there, the unelected officials for the European Union. But Italy voted more so towards the right, the populist movement. Austria did as well. France almost, but not quite. And Spain, there's just uprisings and countries breaking off, or regions breaking off. And this is all due to, well, two major things, right? One is socialism doesn't work, and the European Union's failing, and the debt, and there's no jobs. And the second major reason for this is massive migrant immigration, right? It's just, essentially, Europe is under an invasion. Now, all these uprisings, and then the banking sector in Europe is leading towards a populist uprising across the entire European Union, and it's going to break up the European Union. Now, Italy currently is defaulting on its debts, and it looks like Germany. I mean, they can't just keep printing money and bailing them out. It's at the point where inflation is going to pick up massively for the euro. So, here are some comments. If the Italian crisis becomes a major crisis, it will mainly implode into the Italian economy as opposed to spreading around Europe, this commentator is saying. Because of the way that the Italian economy and the Italian banks are financed, is going to be an implosion rather than an explosion. All right, so, well, I disagree with that. I mean, Italy is the third largest economy, I believe. If it's not the third, it's the fourth in the European Union. So if Italy goes down, the rest of Europe's going to go down. But they always say things like this before it starts happening to not panic the markets, right? I mean, they said the same type of things during the 2008, 2009 crisis. So, Yeah, and once Italy goes, so will Spain, and then the dominoes should keep falling. Essentially, the Italians they don't want to pose austerity measures onto their people. They want to get bailed out, but it looks like Germany doesn't want to bail them out, and it's forcing them to push austerity measures on their citizens, which is no more socialist programs and entitlement programs which they've been receiving. And Europe's just rampant with entitlement and socialist programs. I'm amazed it's gone this far without falling apart. Alright, so China. China, I showed you guys in my last video, the Shanghai. I mean, it looks bad. It looks very, very bad. And China is definitely losing the economic war in the tariff battle with the U.S. And the Chinese market, I mean, I looked at the chart earlier. If it falls just for, I mean, we could take a look at it real quick. Yeah, so here's the Shanghai Composite. It did catch a bid right here. There is support, and we could expect it to bounce for some time. This is not financial advice, though. I could be wrong. But just looking at this weekly chart, it does not look good, right? It looks like the trend is changing. But China could really panic if the Shanghai goes below 2,000. That is when their economy is really going to start falling apart. And they're absolutely in a recession. Technically, it's fallen over 20%. And they're already in a bear market. Bear market is sort of a recession. But a extended recession, depression type situation I would want to see the price fall below 20,000 and continue to keep falling. And then China should be in massive trouble. Alright, so here we have another chart from Ned Davis Warren's High Probability of Global Recession. And this is a good chart. So the shaded areas represent the recessions, right? And this is like a probability model looking at all of the markets and whatnot. And this data that he uses, which has proved to be fairly accurate in the past, is starting to signal that we are getting close. I mean, we're already in that overbought territory where a reset is coming. So a correction is coming. And you could tell every time in the shaded area, that's a recession. Once the blue line here has gone to this overbought, then we'll go into a recession. So here's the 2000. You can see it was overbought, and then it crashed, and that was the Nasdaq bubble bursting. You can see over here in 2008, it was overbought, high recession risk. Then it crashed, and then we had the financial crisis of 2008, 2009. And right now, we're on our way up. And I'm assuming if Trump stays in power and there's more tax cuts and whatnot, we're going to get a boost on Wall Street in the stock markets and the economy temporarily for maybe another 6 months to a year or something like that, which will take us to that very overextended, overbought territory. All right. So Goldman, the Fed will deliver significantly more hikes than are priced in. Here's why. So that's a pretty it's a big statement. So here, I'm going to read a little bit of this. Yet while an end to the hiking cycle would be great news to bulls, not to mention President Trump, Goldman then goes on to note that it is also the case that the economy is sharply outperforming what we would be implied by this approach at present. This means that while the combined FCI and the fiscal impulses imply a growth pace above 3 1/4 quarter above potential, the actual growth pace is instead about 1 3/4 above potential, with a third quarter GDP estimate at 3.5% and our CAI at 3.8%. All right, here's the problem with these. I mean, Goldman's saying that, but the numbers are false to begin with, the GDP numbers, because they're not really pricing in inflation, and they're really not pricing in a lot of things. And then the unemployment's also rigged. This suggests that there are other growth positive forces, a greater amount of self-feeding momentum at work beyond the FCI and the fiscal impulse as we estimate them. Okay, so they're basing this study based off of the fact that the economy is actually growing stronger than the numbers show. I would not agree with that. But you have to think here, okay? So when Goldman Sachs comes out with articles like these, they come out with them for a reason. They might want to get some people to panic sell out so they can buy the dip. All right, you always take this stuff with a grain of salt and think of the motivating factor behind it. All right. Goldman then goes on to calculate about 50% of the current excess growth momentum will persist over the next 2 years, but more importantly notes that one lesson of recent cycles that will prove applicable to the cycle as well, that the FOMC has generally thought it would be prudent to continue tightening until growth has slowed to a potential-like pace, hence Powell's threats to tighten beyond the neutral rate of interest, whatever it may be. All right, so here's the deal. I mean, they're only raising rates at 0.25 basis points. The problem is if the 10-year yield goes, I mean, at some point, the market is going to start crashing if the yields get any higher. If it could be at 4%, it could be at 5%, I don't know, but there will be a point. And every tightening cycle that the Fed has ever done caused a recession. And every recession keeps becoming worse and worse, because every recession, the Fed stops raising rates, starts lowering them, and then starts printing money to stop the recession from going into a full, total economic meltdown, which they created because they popped their own bubble by raising rates. I mean, this is pretty simple. I think the Fed will raise one more time this year in December for 2008. And but if the stock market keeps going higher and higher, they're going to keep raising. So Goldman might be right. I don't know. But there will be a certain threshold. I mean, we could see something where the stock market keeps going higher, higher, higher. The Fed keeps raising interest rates 25 basis points every quarter. And then all of a sudden, boom, it just like a 50% drop, like like a 1 day or something on the stock market. I mean, I'm not saying that's going to happen. I'm just saying that wouldn't surprise me. And, Trump does not want the Fed to keep raising rates. They want them, Trump probably wants them to stop or to raise maybe once every year or twice every year. And that would actually make more sense because the market could handle it more. The problem is Main Street, the actual physical economy, and every American who's pretty much driving around in a brand new car right now and has refinanced their homes and are pretty much in more debt than ever before in history and have to service that debt. And if the interest rates keep going higher, they're going to fall behind on payments, and then you know what happens. All right, so I mean, same thing in 2008. And an indication of that right now, that the interest rates are already too high where the economy can't really handle it. Listen, the interest rates historically are not high. They're extremely low. It's just that that's how fragile and weak the economy is because it's built on credit and debt. It's not built on real manufacturing, skilled labor, services, and productivity. It's built on debt. And when it's built on debt, the slightest increase on interest is like, will bankrupt individuals and corporations because they've taken on too much debt and they can't finance it. All right. So a huge indication of that right now is the home builders. Now, the home builders, a lot of people are talking about this right now, like Peter Schiff. And the whole home builders represent new homes being built and the entire industry surrounding it. Carpentry, construction, Home Depot, everything revolving around building homes. And this also has a lot to do with the home builders are pretty much in line with commercial real estate as well. But as you can see here, look at this. I mean, that is bad. This is the home builders on NASDAQ. And that's a huge drop. Now it has hit support right here. There's major support. Also my blue equilibrium line. So this is not financial advice or anything. I wouldn't be surprised if we see a rebound, kind of a dead cat bounce. It might not happen though. I'm just saying. All right, so but looking at it historically, we could see back prior to 2008, 2007 when so before the 2008-2009 financial crisis, in 2006 and 2007 the home builders started collapsing because of the housing bubble started collapsing a year prior, right? And that's when Bernanke and everyone said, oh, it's contained, it won't spill over to the rest of the economy. But of course we all know it did. So I just noticed huge head and shoulders. Look at that. That would have been a beautiful trade, a beautiful short. Oh man, I would have shorted that if I was a very active trader back then. All right, so we can see the correlations here, right? And right now the home builders are massively falling. You could pretty much correlate this with around this area back then. Of course, the home builders are nowhere as high as they used to be during the housing bubble, and they never will be again, probably in our lifetimes, because that was an enormous bubble. And it takes like many decades for people to forget what happens when you think housing prices are going to go up forever and everyone just keeps buying homes at higher prices and taking on massive leveraged debt. So, but you can see that there is a massive correction in it, and that's dragging down the stock markets. They noticed that. They also noticed the Russell 2000, the smaller businesses, the smaller 2,000 businesses on the Russell 2000 index on the stock markets, right? So that's an indication, a precursor to a warning, right? We don't have much time left, in my opinion. Now, this could bounce, and it could bounce around for some time and give us maybe another year and a half, who knows, 2 years, something like that. But this was a massive sell-off. So looking at gold and silver. Now, I am personally, disclaimer, holding long term. This is long term holding. I don't care what happens if gold falls to $500, $200. I'll still keep holding my stocks, my mining stocks and silver stocks, and I trade other portions of my capital, right? So here's a chart of gold and silver, and the yellow solid line is gold. The candlestick price action down here is the ratio of gold to silver. Now, historically, the ratio, people say it should be 1 to 15, but you know, during the height in 2011, during the very all-time high of gold, the price of gold and silver, the ratio was at 31. So it would take 31 ounces of silver to equal 1 ounce of gold. And that put in the all-time high in the price of gold, right? So I'm just showing you guys this chart. I'm not saying anything. It's not investment advice. So we can see back here, whenever the ratio of gold to silver became the spread on it was too far apart, where it was 1 to 84, it kicked off a new bull market in gold and silver. Back here, so that was, when was the first time on this chart? So in 2002, we saw that, right? We hit the 84% ratio, and then that kicked off a decent bull run, and you could arguably say it lasted till 2011. We did have some pullbacks right here. It started in 08, right, during the beginning of the financial crisis. And then we had a huge dip in the price of gold and silver. And then guess what? That ratio hit 84 again. And then it started falling. And then guess what? It kicked off another bull run in gold and silver until 2011. And then the ratio started picking up again when it hit that all-time bottom of 31. And when the ratio resets to go back up to 84, that entire time gold and silver goes into a bear market, as you can see right here. In 2016, I caught that nice rally. That was awesome. And that was when the Fed started raising rates for the first time in like 9 years, since 2008. We saw that gold and silver ratio was at 84 again. And then that gave us a nice rally in gold and silver, as you can see right here. You see that bump up top here? And then it pulled back. And then gold and silver reset again and started trading sideways. But look at this. Right now, at a current date, we are again at 84. So one can speculate, if history repeats itself, it will set off another bull market, another run in gold and silver. Now, is that 100% positive? No, it's just another trend we see, and we see a pattern which may play out again. Now, in markets, patterns don't repeat, but they do rhyme. So we'll see. We'll see. Keep you guys updated. Alright guys, I think that'll be it for this video. If you guys found this informative, please give me a thumbs up, share the video on Twitter, Telegram, Facebook, wherever, and leave in the comment section what you guys liked, what you didn't like. And this is a brand new YouTube channel. There's like 14 people subscribed. My other channel, WolfPackCryptos, has almost 2,300. And some of you guys who are more interested in the whole global economy, macroeconomics, and you want to diversify in metals, or you have already been interested in metals, oil, and commodities, please subscribe to this YouTube channel, because I am going to have 2 separate YouTube channels, and I'm not going to post my metals and macroeconomic updates on my cryptos channel, because it will just be too confusing, too many videos on just one channel. Alright guys, until next time. And check out the links below to join the free Telegram group. Until next time.